This is Professor Russell James coming to you from Texas Tech University. Welcome to today's lecture from Visual Plan Giving, an introduction to the law and taxation of charitable gift planning. Welcome to Income Limits on Charitable Deductions, Part 5, Complex Combinations. This is Professor Russell James. The previous sections reviewed which income limitations apply to which type of gifts. However, they did not examine how the different limits work together. This is a complicated but important question because a donor may be dealing with a variety of different limits that interact in different ways. A donor cannot, for example, deduct up to 50% of his income with one type of gift, and then deduct another 30% of his income with another type of gift, and then deduct the final 20% of his income with the final type of gift. It may be helpful to conceptualize the interaction of these rules by thinking of 4 different glasses. Each glass represents a specific income limitation rule for specific types of gifts. The question then becomes if the total of each type of gift made during a year can be poured into each type of glass. The first glass can hold up to 50% of income, or up to 60% of income if used exclusively for gifts of cash to public charities. All deductible charitable gifts for the entire year must be poured into this first glass. The second glass can hold up to 30% of income. Into this glass, the donor must put all gifts of long-term capital gain, regardless of the recipient charity, excluding only capital gain for which a, quote, special election has been made. The third glass can hold up to 30% of income. Into this third glass, the donor must put all gifts to private foundations made during the year, as well as any gifts made, quote, for the use of public charities, usually meaning deductible gifts to a charitable lead trust or to a life insurance company to pay for charity-owned life insurance. The final glass can hold up to 20% of income. Into this final glass, the donor must put all gifts of long-term capital gain property made to private foundations during the year. If the gifts of a particular type cannot all fit into the relevant glasses, there will be overflow. This overflow represents carryover deductions that cannot be used in the current year. Note that this spillage or overflow analogy works to calculate which deductible gifts must be carried over. The amount that can be deducted is the total deductible charitable gifts for the year minus what must be carried over. Do not attempt to use the glass analogy to calculate the amount of deductions for a current year by thinking about how much remains in each glass, but instead focus only on the amount of overflow as representing the deductible charitable gifts that must be carried forward into future years. As a first example, consider a donor with $100,000 of income. As before, this means adjusted gross income excluding any net operating loss carryback. During the year, the donor has made a total of $30,000 of gifts of long-term capital gain property valued at fair market value to a public charity, and $20,000 of cash gifts to a private foundation. Next, consider what happens when attempting to pour these gifts into each glass. The first glass can hold up to 50% of income unless it is holding only gifts of cash to a public charity. All gifts must be poured into this first glass. In this case, all gifts combined total $50,000. 50% of income also totals $50,000. Thus, there is no spillage with the first glass and therefore no carryover resulting from the first glass. The second glass can hold up to 30% of income. Thus, in this case, it can hold up to $30,000. Into this glass must be poured all gifts of long-term capital gain, except, quote, special election capital gain. The donor made a total of $30,000 of such gifts during the year, and so once again, there is no spillage. The third glass can also hold up to 30% of income. This third glass holds all gifts to private foundations, which in this case amount to $20,000. The $20,000 of gifts to private foundations can easily fit into the $30,000 glass size, and so, once again, there is no overflow. The final glass relates to gifts of long-term capital gain to private foundations, and no such gifts were made during the year. So, again, there is no spillage. Because there was no spillage or overflow out of any of the four glasses, there is no carryover. Thus, all charitable deductions will be allowed in the current year. Remember that in this analogy, the amount of charitable deductions allowed in the current year is the total amount of deductible charitable gifts, less any gifts that must be carried forward. The previous example did not create any carryover. However, before looking at one of these carryover examples, it is useful to know which types of gifts get deducted first and which types of gifts are carried forward first. For example, if there is spillage out of the first glass into which all gifts must be poured, which gifts are carried forward? This is an important issue because the gifts carried forward retain their original identity and consequently must, in the future year in which they are used, be able to fit into each income limitation glass related to that type of gift. Fortunately, the question of which gifts are deducted first follows the same pattern of preference seen with regard to which gifts have the highest income limitations. In other words, the more preferred gifts will be deducted first, and the less preferred gifts will be carried over first. So the most favored gift, cash, given to the favored recipient, public charity, will be deducted first. Moderately favored property, non-cash property that is not long-term capital gain property valued at fair market value, given to a favored charitable recipient, for example a public charity, will be deducted second. Third, disfavored property, long-term capital gain property valued at fair market value, given to a favored charitable recipient, for example a public charity, will be deducted. Fourth, any favored property, cash or non-cash that is not long-term capital gain, given to a disfavored charitable recipient, for example a private foundation, will be deducted. Finally, the last type of gift to be deducted, and therefore the first type of gift to be carried forward into future years, is disfavored property, long-term capital gain, given to a disfavored charitable recipient, for example a private foundation. This is the order that determines which type of gifts will be counted first. If there is spillage out of a glass containing multiple types of gifts, such as the first glass which must contain all gifts, this ordering determines which type of gifts must be carried forward. In this next example, the donor once again has $100,000 of income. During the course of the year, the donor has made a total of $30,000 of cash gifts to public charities and $30,000 of long-term capital gain property gifts valued at fair market value to public charities. The first glass holds up to 50% of income, in this case $50,000, or 60% of income if it is holding only gifts of cash to a public charity. All deductible charitable gifts of any type must be poured into this first glass. The donor has made a total of $60,000 of deductible charitable gifts during the year. If these gifts were only cash gifts to public charities, they could all fit into the first glass. But because they are not, the $60,000 cannot fit entirely into the $50,000 glass. Thus, there will be spillage and therefore carryover. There are no similar problems with the second glass, which can hold up to $30,000 of long-term capital gain gifts because only $30,000 of such gifts were made during the year. These long-term capital gain gifts were not subject to the special election because they were valued at fair market value, in other words, FMV, in the accompanying slide. No gifts were made to private foundations during the year, so nothing goes into glasses 3 or 4. There will be carryover due to spillage from glass 1. But which gifts have their deductions carried forward? Because the first glass cannot hold all $60,000 of deductible gifts made during the year, some gifts will have to be carried forward. The $30,000 of cash given to a public charity is the most favored kind of charitable transaction. Consequently, this gift will be deducted first. This means that the $10,000 of carryover will come entirely from the capital gain property gifts made to public charity. What happens if there are different gifts given within the same category? For example, if there are gifts of short-term capital gain property to a public charity and also gifts of inventory to a public charity, which one gets carried forward? The answer is that it doesn't matter because both of these types of gifts are treated identically for tax deduction purposes. Because there is $10,000 that cannot fit into the first glass, this $10,000 of charitable deduction for fair market value capital gain property must be carried forward into future years. In this next example, the donor still has $100,000 of income. The donor makes a total of $55,000 of cash gifts to public charities and $30,000 of gifts of long-term capital gain property valued at fair market value to public charities. How will this giving fit into the income limitation glasses? The total giving of $85,000 will not fit into the first glass, so there will be carryover of some deductions into future years. The second glass holds only gifts of long-term capital gain property. It can hold up to 30% of income, or in this case, $30,000. The donor made $30,000 of gifts of long-term capital gain property, so there will be no carryover resulting from this glass. The third and fourth glasses are irrelevant because no gifts were made to private foundations. Deductions from some gifts will be carried over as the result of spillage from the first glass. As before, the most favored types of gifts are counted first, leaving the less favored gifts at risk of being carried forward. Thus, the $55,000 in gifts of cash to a public charity go into the first glass first. Because the first glass is holding only gifts of cash to a public charity, it can hold up to $60,000 in such gifts. Consequently, all $55,000 in gifts of cash to a public charity fit into the glass. However, none of the $30,000 in capital gain gifts will fit into the first glass. The increased capacity from $50,000 to $60,000 applies only to gifts of cash to a public charity, not to capital gain gifts. As a result, all $30,000 of capital gain gifts spill out of the first glass and must be carried over into the future years. Even though the $30,000 of capital gain gifts do fit into the second glass, they must still be carried forward because they do not fit into the first glass. The $55,000 in gifts of cash to a public charity does not spill out of any glass and thus can be deducted in the current year. The first glass can hold the entire $55,000 in gifts of cash to a public charity because it can hold up to 60% of income when, as in this case, it is holding only gifts of cash to charity. It is not holding any of the capital gain gifts, as these all spill out of the glass and must be carried forward into future years. In this next example, the donor again has $100,000 of income. During the course of the year, the donor makes a total of $2,000 of cash gifts to public charities, $56,000 of gifts of long-term capital gain property valued at fair market value to public charities, and $5,000 of cash gifts to private foundations. Will this giving fit into the income limitation glasses? The first glass can hold up to $50,000, or $60,000 when holding only gifts of cash to a public charity, and it includes all deductible charitable gifts made during the year. In this case, the donor has made a total of $63,000 of deductible charitable gifts. The special $60,000 limit does not apply here because only $2,000 of the gifts were cash gifts made to a public charity. Consequently, the first glass can hold only $50,000 and there will be $13,000 of spillage out of this first glass. The second glass can hold up to $30,000 and includes all gifts of long-term capital gain, except that subject to a special election. The donor, however, has made $56,000 of long-term capital gain property gifts valued at fair market value and therefore not special election property. Thus, there will be $26,000 of spillage out of the second glass. The third glass contains all gifts to private foundations and can hold up to 30% of income, which in this case means $30,000. The total gifts to private foundations were $5,000, so there is no spillage out of this glass. There were no gifts of long-term capital gain to private foundations, so the fourth glass is not relevant. Which gifts are carried forward? The first glass will have $13,000 of spillage because there were a total of $63,000 of deductible charitable gifts, and 50% of income is only $50,000. Gifts of cash to a public charity are the most favored type of gifts and so will be deducted first. Gifts of long-term capital gain to a public charity are deducted next. However, the cash to a public charity of $2,000 and the long-term capital gain property to public charity of $56,000 exceed the $50,000 holding capacity of this glass. Thus, $8,000 of the long-term capital gain property gifts to public charity must be carried forward into future years because it has spilled out of the glass. Gifts of cash to a private foundation are deducted third, after gifts of cash to a public charity and gifts of long-term capital gain to a public charity. As a result, all $5,000 in cash gifts to private foundations spills out of the first glass and must be carried forward into future years. In this case, there is also spillage out of the second glass, which makes things more complicated. The second glass can hold a total of $30,000, 30% of income. However, the donor made $56,000 of this type of long-term capital gain gifts. Thus, $26,000 of these long-term capital gain gifts spill out of the glass and must be carried forward into future years. $8,000 of that $26,000 of long-term capital gain gifts were already being carried forward because of the spillage resulting from the first glass. However, this just means that this particular $8,000 of long-term capital gain gifts will be carried forward for two different reasons. That is, spillage out of glass 1 and spillage out of glass 2. Note that the gifts for the year must fit into each glass separately. The calculation for each individual glass is not affected by what happens to the other glasses. It is not appropriate, for example, to say that only $30,000 of fair market value long-term capital gain property gifts must go into glass 1 because the rest has spilled out of glass 2 already. Each glass is calculated without regard to the other glasses. This means that the same gift could be carried over for multiple reasons. In other words, the same gift spills out of multiple glasses, as happened here with the $8,000 of long-term capital gain gifts that spilled out of both glasses 1 and 2. The result here is a carryover of both $26,000 of fair market value long-term capital gain property gifts to public charities and $5,000 of cash gifts to private foundations. Thus, $31,000 of charitable deductions in total must be carried forward into future years. The donor made a total of $63,000 of deductible charitable gifts, and $31,000 must be carried forward into future years. As a result, only $32,000 may be deducted this year. Remember, the glass analogy is used to calculate the amount of carryover. To calculate the amount that can be deducted in the current year, simply subtract this total gifts carried over from the total deductible charitable gifts for the year. Do not attempt to calculate the deductible gifts for the year by using the dollar amounts with check marks by them in the accompanying image. Note that the $5,000 in gifts to private foundations was well below the maximum for glass 3, but this gift was still carried forward because of the spillage from glass 1. Returning to the three categories of gifts made by the donor during the year, the $5,000 of cash given to private foundations generated no deduction for this year, but did generate $5,000 of carryover deductions for future years. That $5,000 of carryover deductions will, in future years, still be treated as deductions for gifts of cash to private foundations. Thus, in order to be used, these carryover deductions must be able to fit into the relevant income limitation classes for the future years. The $2,000 of cash gifts to public charities will all be deducted this year. Finally, the $56,000 of fair market value long-term capital gain property gifts to public charities resulted in a current year deduction of $30,000 and $26,000 of carryover. Again, this $26,000 of carryover will, in future years, still be characterized as fair market value long-term capital gain property gifts to public charities. In this next example, the donor has given $20,000 of fair market value long-term capital gain property gifts to public charities and $20,000 of long-term capital gain property gifts to private foundations during the year. These gifts total $40,000, which fits into the first class. However, all of these gifts are of long-term capital gain, and all $40,000 will not fit into the second class, which holds only $30,000. Thus, there will be $10,000 of carryover. The third class holds up to $30,000 in this case and contains all gifts to private foundations. Only $20,000 of gifts were made to private foundations this year. Therefore, there is no carryover resulting from Class 3. Class 4 can hold up to $20,000 in this case and contains all gifts of long-term capital gain property given to private foundations. Exactly $20,000 of this type of gift was given, and consequently there is no spillage from this fourth class. The previous slide indicates that $10,000 of deductible charitable gifts will have to be carried forward because of the spillage from Class 2. But which type of gift is carried forward? Because long-term capital gain property gifts to public charities are deducted before long-term capital gain property gifts to private foundations, all $10,000 carried forward will be gifts of long-term capital gain property given to private foundations. Thus, even though the entire capital gain property gift given to private foundations fits into classes 1, 3, and 4, $10,000 of this gift must still be carried forward into future years because of the spillage from Class 2. In ending this examination of income limitations on charitable deductions, it is perhaps useful to recognize that this material is among the most complex in all of charitable gift planning. The analogies, explanations, and themes used in this chapter are intended to help the listener understand the rules intuitively. However, the comparisons made using spillage out of a glass and describing favored and less favored property and favored and less favored charitable entities are not examples or terms that come from the tax code or the IRS. These are put here only to be helpful. To the extent that these ideas do not help to visualize and internalize these rules, feel free to disregard them and focus more directly on the exact language of the Internal Revenue Code. This has been Income Limits on Charitable Deductions.